All right, welcome to the What's Your One More podcast. Today, I'm joined by Dan Habib. Thank you so much for being on this show today. It's an honor and a pleasure. And, we got a chance to know each other dating back to 2019. And, the organizations that you work with right now, I can't say enough great things about you. You're a 10-year veteran, technical trader. I hear some of the bond advice and some of the technical analysis advice you give, and my mind just is absolutely blown every single time. You are an EVP at MBS Highway, which provides technical market analysis to over 30,000 subscribers, which is just amazing to watch you guys' growth over the last 3-4 years. It's been awesome. And you're also an EVP at Cryptocharged, and that's one of the things we were going to talk about today because a lot of people I wouldn't say I know can say what I'm about to say here is that you're a 7-figure crypto investor and a trader and a successful one at that. That's another thing I don't really get a lot to say because I'm around a lot of people that think they know crypto or they think they know the market space, and turns out, well, that's not the case. They just did real good one time, and you have consistently done well. And today, I'm glad to have you on the show to kind of talk to our audience and listeners because, there's a lot of mixed vibes about this. There's a lot of really just people that don't know and maybe afraid. And then there's people that kind of have tiptoed in, had a little bit of success, maybe got burned or maybe took that success and got out. And then there's those that maybe, lifers holding on for dear life, but just don't know what to do. Are they in the right position? Are they waiting for the bounce back? But today, I want to welcome our audience to the crypto space, and I'm so excited to talk about this with you because, you're going to only not bring a crypto advice, but you're going to bring world advice, inflationary advice, what's going on with the markets, why this is, a great investment, maybe a potential hedge, and talk, and I think just really educate all of us on some things that we're unaware of. So again, can't say enough great things. Thank you so much for being on the show, and this is so exciting. So thank you for being here.
Well, thanks so much, Quentin, and I've certainly enjoyed our friendship developing over the last few years. And, it's an honor to be with all of you here today. And there's a lot to talk about, right? There's a lot of things happening in our economy. We have, near 40-year high in inflation. You got the Federal Reserve, who is literally trying to destroy the demand side of the economy and tighten it down. You have a bear market in the equity markets. You see cryptocurrencies down roughly 70%. So, all of these things are somewhat connected. And what I really want to do, my goal here today is to introduce you to the crypto space, but really take it kind of step by step. I think that it can be a complicated topic, but the goal here is to try to really hold your hand and walk you through this in a way that hopefully you can understand if I do a good job of it, and maybe open your eyes to some opportunities that may exist. So I think it's important first to just kind of start with a backdrop of what's happening in the economy right now, because I think some of the issues that we're experiencing really led to the reason why people wanted to create cryptocurrencies. Mm-hmm. So, inflation, right, is the definition of that. And this is the biggest problem in our economy, but not just the US, it's the biggest global issue that we're having. So the textbook definition is too many dollars chasing too few goods. Well, how'd we get in this situation where we have this 40-year high in inflation? And listen, you guys are all feeling it, right? You go to the store, you go to the pump, things are costing more. What inflation truly does is it erodes the purchasing power of the dollars that you have. It also kills savers. If you have an 8% inflation rate, if you have $100 in your account today and inflation goes up 8%, it'll still say $100 next year in your savings account there, but it's going to feel like 92 based on what value it actually has. So too many dollars chasing too few goods. How did we get here? Well, a lot of it has to do with the money supply, the amount of dollars that's out there, the amount of credit that's out there. We're very much a credit economy. And this came from really the government and a mixture of way too easy Federal Reserve policy. So you had trillions and trillions of dollars of stimulus that, very clearly you can see inflated the money supply. But you also had the Federal Reserve, who, in my opinion, they're responsible for a lot of this. And, many of them not having real world business experience, but many of them being academics. And, I know that they certainly have good intentions, but they are part of the reason why we see these boom and bust cycles. They oftentimes are looking at data in the rearview mirror to dictate decisions that they're making in the current economy. A lot of the stuff they're looking at operates on a lag, and they oftentimes overcorrect. Almost like if you're getting in the shower and the water might be coming out cold, so you turn it all the way to hot to try to warm this thing up, and then it does so, but then eventually a few seconds later you're burning your skin and you're scolding yourself because you overcorrected. The Fed has been known to do this time and time again. So what's happening here is the Fed is and by the way, the too few goods, that was also due to COVID, where you had supply chains that were decimated, and they still are nowhere near where they were pre-pandemic. So too many dollars, too few goods, and prices go higher.
Dan, can I ask you, would one of those goods be housing? Just out of curiosity.
Yes. So, we've seen all asset prices rise, right? Whether it's housing, whether it's, stocks, we've seen inflation in really all areas of our economy.
Yeah.
Now, when we talk about what the Fed is trying to do to curtail this inflation, they have certain tools at their disposal. One of them being the Fed funds rate, right? And the Fed, what they were doing prior, part of the reason why they're really responsible is because they kept that Fed funds rate at zero for many years. And what they did is they also did a ton of asset purchases. So they were injecting liquidity into the mortgage markets, and they were doing a ton of buying of mortgage bonds, which is where mortgage rates come from, as well as treasuries. And by doing that, they artificially kept interest rates low. And when that happens, what occurs? Well, it promotes borrowing because money is cheap, and that creates more money in the system. So you saw the money supply in like an 18-month period go up by about 40%. And not only is that not sustainable, but it leads to inflation. So now the Fed, they were believing that inflation was going to be transitory. Even though inflation was rising, they continued to keep buying. And now they've done a 180. And now they're talking tough. They're saying how they want to inflict pain. It's going to be pain in the short term. And what they're literally trying to do is destroy the demand side of the economy. They can't do anything with their tools to all of a sudden clear up supply chains. But what they can do is they can raise what's called the Fed funds rate to make things more expensive, to make some types of borrowing more expensive, and then hopefully slow down the economy so inflation can come down and supply chains can catch up. Now, when they hike, there's a lot of misinformation there. I even see prominent media channels out there saying that the Fed is hiking mortgage rates, and they're actually even doing the math. They go 75 basis point hike. This is how much your mortgage payment is going to go up. Couldn't be further from the truth, right? There can certainly be indirect impacts, but the Fed is hiking what's called the Fed funds rate. Instead of a long-term rate, like a 30-year fixed rate that is in place, has a really long duration, they're hiking an ultra short-term rate. It's actually an overnight rate that banks use to lend to one another. Now, when they raise this, it does have a direct impact on certain things. Your credit cards can go up. Your car loans go up, right? Your personal loans, your small business loans, which is a big one. Imagine now small business loans, when the Fed funds rate was at zero and now it's at 3.25, going to 4% on November 2nd, that is something that is going to deter businesses from expanding and slow down growth. So these are how the Fed is really trying to address this inflation problem. But the problem is the Fed doing too much too fast? Because when you take a look at history, almost every time the Fed goes through a rate hike cycle where they hike, and this was one of the most aggressive ones in history, you always get a recession that occurs. Why? Because the Fed slows down the economy too much. Now, we're already starting to see some signs of a recession. There's many indicators out there that you can look at, but clearly manufacturing is in a recession already. Housing is definitely in an activity recession, and housing activity contributes to 13 to 15% of GDP or so. We'll get to prices. I don't think that we're going to see any kind of housing crash like some people might lead you to believe out there, but there's certainly softness, and activity is certainly soft. Sales are down, pretty big. If you look at applications, purchases are down 42%, refis are down 86%. But some of the signs that I'm looking at, besides seeing all the manufacturing numbers regionally being negative, shipping looks like it's in a recession. When you take a look at two negative quarters of GDP that we saw in Q1 and Q2, by most people's definitions, we would officially be in a recession, but they have kind of moved the goalposts a little bit. That's the NBER, the National Bureau of Economic Research. They're the ones that are kind of like the referee here that calls a recession. But we've also seen some things, and you may have heard this kind of buzzword before. It's called an inverted yield curve. Now, a normal yield curve, a positive one, which is what you normally would see, is up and to the right, meaning if you invest your money for 2 years, a 2-year treasury, versus putting your money for 10 years, you'd expect to be rewarded for putting your money away for a longer period of time. You'd expect the 10-year yield to be higher. But right now, you're seeing the 2-year yield more than 40 basis points higher than the 10-year yield. Now, that sounds kind of backwards or upside down or inverted. And if you actually look, the 3-month went higher than the 10-year just this past week. So, and by the way, there's a couple potential investment ideas I have for you on that note that I'm personally going to be doing. But this is a sign. What was that?
I said I can't wait to hear this because I got a feeling it talks about taking advantage of these 1-year treasuries right now.
Yeah. So this is something that, when you see this, you're being rewarded, and there's more risk potentially in the economy in the short term than the longer term. And when you see these things occur with almost 100% certainty, especially when you see the 3-month higher than the 10-year, that's always a sign that you're going to have a recession. So, the backdrop here is that I believe inflation is going to come down. I think it's going to start to come down at the end of the year and really into next year. So while I think that that's going to improve, and I think the housing situation is going to improve, I also believe the damage is already done. And I think we haven't seen the bottom in the markets yet. We're certainly in a bear market, but I think we're going to see another kind of capitulative move, especially as we go into a recession. If you take a look at, if we're not already in one, right, they're always kind of looking in the rearview mirror and classifying a recession after the fact. But I believe that we haven't seen the bottom in stocks, and I don't think we've seen the bottom in crypto. So while that can be painful, as long as you don't have an ultra short time horizon, a lot of damage has already been done. So I wouldn't recommend going and just dumping all your stocks now. And there's also, extraneous forces that can impact things, and nobody knows for certain how this is going to shake out, if the Fed's going to pivot, how long and deep this recession will be. But while it's challenging, I think it presents a lot of opportunities because a lot of things are on sale right now.
And that's what I'm looking forward to talking about. There's a lot to unpack in all that amazing advice you just gave and market analysts, what's going on. The one thing I want to go back to is it fair to say this is the first time that I know that I can recall, but is this the first time some of our Fed has seen global inflation at the rate of what it is right now?
For sure.
And is it fair to say the danger of that is if we go back to the 80s, in the 70s when the U.S. was rate hiking at the level it was, it put other countries' monetary system in danger, especially the peso in Mexico. And so we're kind of seeing something similar happen with the euro right now. We're seeing significant price pressure put on other countries' monetary systems to the point of a lot of people believe that the Fed's going to go until they break something. And then once they break it, they got to call a timeout and go back to what we were doing, which might be the easing we were talking about.
Yeah. So you bring up some great points there, right? So we are certainly the dollar. A lot of things are denominated in the dollar, right? I mean, we have a pretty important place in the global financial world. Gas is in dollars and stuff. So when you talk about the Fed hiking, obviously, we're more concerned with our economic situation in our own country when their Fed's making these decisions, and they're supposed to be autonomous from any kind of political pressures or, warnings from the International Monetary Fund that they're going to hurt other countries and such. And, recessions, oftentimes can be synchronized because the global economy is so connected. But what happens is that because we're ahead of the pack with our rate hikes, meaning we've been the most aggressive compared to other nations. Because of that, and because of the safety of U.S. investments, you're seeing a lot of foreign participation in our treasuries, especially the short-term treasuries. And, it's pretty attractive when you see a yield of 4% and change for a 3-month treasury or a 6-month treasury. I mean, that's a pretty high annualized rate of return in something that is essentially risk-free, backed by the full faith and credit of the U.S. government. So think about how this works. You have foreign investors investing in a U.S. bond or treasury. They have to take their money and they have to turn it into dollars, right? So when they do that, if you look at the dollar, it's gone like just straight up, right? So the dollar has been going up. And while that is something that is good for imports here, because our dollar is more expensive, more valuable comparatively to other currencies, boy, it makes our exports much, much cheaper. It makes gasoline prices rise much more for them comparatively to us, anything that's denominated in the dollar. And it can certainly have a crippling effect on some of these other countries there. It's also part of the reason why when the Fed hikes, and that causes our dollar to move higher, when the Fed hikes, it's not really well received by the risk on markets like equities, because about half of the earnings of the S&P 500 comes from overseas. Well, if now our products are more expensive, that's certainly not going to help with sales. So, all of these things are connected to one another here. But I might as well just mention it now. When the Fed hikes November 2nd, which is actually tomorrow, as at the time of recording this. So,
Right.
but this is something that is going to cause short-term yields to rise with it. I'm actually waiting for that. And then I am going to, with some, either some cash that you have, or if you have some tax obligations that you have in an account, instead of, letting them sit there and, not earn too much, I would seriously consider investing in a 3-month treasury, where I think it'll be probably close to 5% once the Fed hikes November 2nd. And that's a pretty attractive rate of return, and you're not locking your money up for too long, so you can still be quite nimble, and that's something personally that I'm going to do. But, we've started to see some of the Fed members and some of the other central banks look like they're starting to really listen to some of the concerns people are having with, are you doing too much too fast? Even Lael Brainerd, our Fed vice chair, she voiced concerns that, hey, sometimes these Fed rate hikes could take 6 months to really impact and show their true impact on the markets. Maybe we should slow down a little bit to see that and realize that impact before doing too much. And we've started to see other central banks like this as well. Bank of Canada, they just hiked 50 basis points, which was a surprise to the downside instead of 75. The Australian Central Bank, they just hiked 25 instead of 50. The ECB just snuck in at 75. However, they did say we've made substantial progress in removing some of the accommodation that was in the system, which kind of lays the groundwork for what I think is going to be maybe 50 next time. And then how about the US? We know 75 is pretty much a sure thing for this November meeting, but the next one is December 14th. Now, December 14th, initially, it was thought they were going to do 75 basis points, especially because inflation, core inflation, which is what the Fed cares about, rose on the CPI from 6.3 to 6.6 in the last report. So going the wrong way. Remember, the Fed wants like 2% core inflation,
Right,
or at least substantial progress to it. However, the Fed has a mole, and that is Nick Timiraos. Nick Timiraos writes for the Wall Street Journal, and many Fed presidents have had somebody like this, where the Fed doesn't want to scare the hell out of the markets. So he pretty much is the mole out there that writes for the Wall Street Journal and kind of prepares the markets for what the Fed's going to do. And if you read what his pieces have been before the Fed meetings, at each of the last meetings, he's pretty much given you the playbook, right? So what he said is he thinks they're going to use this November 2nd meeting to try to prepare the markets for 50 basis points in December, meaning the Fed appears to want to potentially take their foot off of the economic brakes that they've been putting on the economy, because they're fearful that they're going to send us into a recession.
Yeah, and that kind of helps the markets price this stuff in too, and that leads to some of the discussion we're going to have. It's not always great. It's very volatile when you have someone that can kind of forecast or is the mole and tells you what's going on. And the way we get data nowadays is much different than you go back to the late 70s, early 80s, when fax machine was the fastest way we were getting data versus now. So to have someone do that, things are getting priced in much quicker, much faster. The last question I wanted to ask, unpacking all of that as we dive into this crypto channel we're about to go into. The Federal Reserve, every time they do something, it takes time to implement through the system. This is not a super quick thing. I mean, there's some belief it takes up to, at minimum, 90 days to get through the system to see the other sides of these rate hikes and what's going on. So even today, we may only be seeing the first 2 rounds of the rate hikes really show up in our market space. We still have some more behind us that are coming.
100%. I think it could even take longer than that. The markets obviously will try to price it in, right? So once the Fed does some type of action, you'll see the stock market, the bond market try to price it in. But remember what they're doing and the impact that they're trying to instill, for that to actually work its way through the economy and fully be realized, doesn't happen right away. It could take up to 6 months, in my opinion. So that's why a lot of people have been critical on the Fed, because they don't even know how much they've slowed things down yet, because those rate hikes haven't fully been realized.
Wow.
Quick take before we jump into this. Rates, what do you think they're going to do in the first quarter?
I believe you're going to start to see inflation, which is the main driver of mortgage rates, start to come down at the end of the year. And I think you're going to see substantial progress next year. So my prediction on mortgage rates, I think you can get back down to around 5% the first half of next year, which I think would be welcome news to people, especially in the mortgage and real estate industries, because activity has certainly been a little bit scary, right? And having a 7% or above interest rate, a lot of people aren't moving with their 3% rates. And the one good thing that I do see on that housing front is that It appears to me that builders learned their lesson from 2006 and 2007.
Agreed.
So what I mean by that is that back then you saw demand that was waning, but builders put up record numbers of homes. There was like 4 million existing homes for sale. Builders just kept building. When you take a look at today, yes, clearly activity has chilled, but you have really, really tight supply, 1.25 million homes, and some of those are under contract. So you look at active listings, 740,000. It's tight. And if you look at the builders, they're not building. Housing starts, which is like breaking ground to create a single family house, down 20% from last year. Housing permits, really the precursor to that housing supply, down 17.5% for single family homes from last year. So what this tells me is that, listen, there's a lot of doom and gloom out there in the media. I think you can see some softness month to month. Most people's time horizons aren't 3 months they're going to live in a home. It's 11 years or so, right? I think you could see some vacillations, but I certainly don't see any type of crash-like conditions like some people would paint the picture in the media. I actually think, in a weird way, this could be the opportunity that people were waiting for. You know, if you remember, it wasn't too long ago, there was 30 offers on a home. You had no ability to negotiate. You couldn't even get an appraisal or an inspection. You had to buy it sight unseen. Those things have gone away. You can get seller concessions now. You can get a 2-1 buy down that's paid and refi next year and use the credit remaining from that probably to pay for the refinance where available, that if you can do a 2-1 buy down. But also you can negotiate here, right? And I think that if you wait, because of the inventory picture and because builders learn their lesson, when rates come down to 5% next year, like I'm predicting, you're going to see the frenzy start again. And I think it lays the groundwork for a reacceleration, and you may have missed your opportunity. Because there's a lot of people right now that want to move, but rates are much higher. They're not going to move from their 3% rate to a 7.25% rate, right? So that's the way I'm seeing it in the housing market, but certainly could see some vacillations.
I couldn't agree more. And you and your you and your dad have done such a great job of eloquently pointing out one thing that I think gets missed from the 05, 6, 3, 4, 5, 6, 7, 8, 9, 10. The millennials were in their teens at that point. So the population of pool of buyers right now is humongous compared to that point, which speaks to the lack of supply that we have is only going to get worse because we've got 89, 90, 91, and 92 birth rates getting ready to come online. And that's going to be those are some of the higher birth rates of the millennials. So to your point, there's not enough supply looming in the background because maybe the builders have learned from their mistake. They're not doing as much, and that's going to show up. And it's going to be essentially maybe not at the pace of 2020, but it's going to feel like 2020 all over again if those rates drop. And for the other person of that side of the coin that I think is hilarious, he goes, well, I'm just going to wait for the prices to drop. I laugh because I'm like, do you think you're the only person that thinks like that? There's like the rest of the half of the world that thinks like that too. So that's going to be another pool of buyers that come attack, probably hedge funds that come attack that as well. So it's always interesting nonetheless. Well, I really appreciate that outlook and update on what's going on in the economy. So let's dive into the crypto space. For our audience, can we just take a minute to define what this is and why it came about? Or what exactly is, I think people hear crypto, they think Bitcoin, but there's so much more to it. Can you kind of fill us in?
There's a ridiculous amount of coins out there now. Okay. I mean, thousands and thousands and thousands of different coins out there. Doesn't mean you should invest in all of them. Many of them, maybe don't have what I like or what people call utility, right? No, like real, like kind of purpose behind it. Just like there's meme stocks out there that you can make a lot of money on. If you're on the right end of it, you could also get really hurt with those. There's meme coins as well. There's some pump and dump schemes out there. There's, obviously like in any new sector, there's some people that give it a bad name or a black eye, but it really is amazing technology. And I think that it's something that we're seeing be adopted, but the smartest minds in the world are innovating in this space. And I think that this is going to have a profound impact in just the next few years with how we do things, how we verify things, how transactions are processed. There's so many different venues for how it can be transformative. And I think it's almost going to have an impact, just like the internet, which, now you can't imagine life without the internet, right? I mean, you could take away my phone, but if you take away my internet, I can't do anything, but the internet, you can't even remember time before it almost, right? It's like a basic building block that you need. Well, I think cryptocurrency is going to be transformative in that way. So I like to try to start breaking this down with some of the stuff we actually already talked about, right? So when you take a look at why crypto, in my opinion, was created, or some of these were created, I think it has to do with how everything in our current financial system is centralized. And by centralized, it means that we really rely on the government and we rely on the central bank, the Fed, and they have very important roles that they play, right? I mean, the Fed is really dictating the price of money essentially, and they are really playing with the money supply out there. They're able to, adjust rates or inject liquidity, keep rates low. I mean, we talked about some of the things that the Fed is doing, and they have part of the reason why we're seeing these boom and bust cycles. We're seeing inflation go crazy. And we also rely on banks to facilitate transactions, right? So banks play a very important role in our economy. A cash transaction is pretty easy to understand. You give me the good or service, I give you the cash. It's pretty clean and finite, right? But most of our money is done digitally now, right? Whether it's PayPal, whether it's Venmo, you swipe your debit card. It's actually very few cash transactions, respectively, to the overall scope of things. Well, how do you keep track of that, right? How do you manage that? How do you make sure you're not double spending the digital dollars that are out there? Can I go swipe my debit card 10 times real quick and spend more money than I have in my account? So you need somebody to record this. And that's where the banks really come in. The banks help to facilitate the flow of money in our economy. And Wells Fargo, let's use as an example. They keep a ledger for me. I have an account with Wells Fargo. So, behind their security wall, they have a ledger there that keeps track of a direct deposit that comes in from work, my mortgage payment that goes out. It keeps a running tally and it keeps this live number. So you can see in real time if I have the money that I believe I do have in there. And so I can't double spend. So cryptocurrency, in my opinion, was really created to create, I like to think of it, and we're going to talk specifically about Bitcoin here for a minute, but it's like a new monetary system. But it's a monetary system that exists without the need for a central bank, without the need for these banks to facilitate the flow of funds. And it's not too different in that there's still somebody keeping the records, right? And there's still a ledger, just like the bank keeps a ledger, right? But it's not done centrally. So I have a couple slides that I think can help to kind of go through some of this stuff, but we want to just take it slow and take it step by step so you can get your arms around it. So let me just share my screen here. So, there's some other criticisms that come into effect when talking about the government, the Fed. And I just want to just clarify, I'm not here to say that one system is right or one system is wrong. Clearly our monetary system has been in place for many years and, it certainly has worked, right? But that's not to say that there's not some critiques. So, obviously we talked about how, they can create money, our government and our Federal Reserve, right? They can print money, right? They don't use a printing press anymore. It's created digitally. But these things can cause inflation. They also can change the record, meaning, some companies could be deemed too big to fail. You guys remember the financial crisis? They can change the ledger. They could erase debts and say, guess what? You don't owe that anymore, right? And the Fed is really a big reason why we've seen the money supply increase about 40% over an 18-month period. And we saw inflation get up to about 9.1% was the high. It's come down a little bit since, but it's still extremely elevated. So besides, banks really helping to facilitate the flow of transfer of money in our system today, there's some problems with banks out there. You've heard about some bad players churning accounts and such, but I think when most people think of our banks, we think about us owning that money, right? And we kind of think about our money being safe in that bank. And yes, it is to an extent. But the problem is that do you really own that money when it's at the bank? We've seen some horror stories lately. If you look at Canada, when they had that freedom convoy, people that were supportive of it, Canada froze your bank accounts. Imagine not having access to your money. In Russia, this is going on as well, freezing your bank accounts. But also, when you send money through banks, it does a reasonable job, but it's pretty slow. If you're on the receiving end of it, card payments could take up to like 48 hours to process. Checks could take 72 hours to clear. ACH, 48 hours. Domestic wires, you can get those done in a day, but international, forget about it. Expensive, takes a long period of time. And you can't really go to the bank. Yes, you can go to the ATM and stuff, but after 5, most banks are closed. Weekends, banks are closed. So do you truly bank yourself would be my question. And the answer is no. Well, with cryptocurrencies, that doesn't exist. And you do, in fact, bank yourself. And you and only you have access to your cryptocurrencies. And you can send them to anybody you want in the world at any time for much cheaper and much faster than you can do through traditional means of finance in our centralized world. So these are some pros and cons here that we're going over. And an analogy I like to use is the internet, which we touched on earlier, right? But what Bitcoin is really trying to do is decentralize money, right? Not have these big players being necessary in the system and being reliant on them. And I think a lot of the people in the crypto world feel like decentralization is important because when somebody has too much power, there's always potential for manipulation or misuse. And this is something where if we can make monetary system actually work without the need for those things, it could make a lot of sense. Well, information really, it used to largely be centralized. Before the internet happened, if you wanted to learn about history, what would you do? You'd go to the library, right? You'd get an encyclopedia. You guys remember those Britannica encyclopedias, right? And you would read history, right? Now, you had a few thousand writers that wrote this, right? So it certainly could be written through a certain lens, right? Maybe they could have omitted stuff, but also there's an old saying, history is written by the victors. I'm sure if you read a history book in the US versus some other countries, you might have a different skew on the history of events there, right? Well, this all changed and information, I think, became much more decentralized when the internet came on. And instead of just a few thousand writers, something that would be analogous would be, well, now you have Wikipedia, where you have hundreds of thousands of writers all around the world that are fact checking each other. I think it's a much better way of really keeping the record straight. You have people to keep you honest, and you have a much broader spectrum there. So much like the internet decentralized the flow of information, I think that that's what Bitcoin is trying to do with the flow of money. So how does Bitcoin work? Listen, you can get really in the weeds on this, right? And we're not going to do that today because I don't think that that helps you conceptually to understand how it works. But the Bitcoin system here, the protocol, right, as they call it, I'd like you to just kind of think of it as a new monetary system, right? So you have our current monetary system. We've kind of talked about some of the ways that works, the Fed, banks, their roles. Bitcoin is a new monetary system, but without any of those big players. It's decentralized instead of centralized. And you have complete control of your money within this system. You don't have banks. You actually have your own wallet that you can, if you memorize, 12 words, you can take it offline and you can take those 12 words anywhere in the world, or you can memorize them and then you can have access to your money, right? And you can send your money to anybody you want. Now, when we talk about Bitcoin specifically, this is really like the granddaddy of all the coins. And, Bitcoin, I think, really laid the groundwork for all these other cryptocurrencies, and it really proved the proof of concept. And, you might be asking yourself, well, why does Bitcoin have any value, right? I mean, you see a lot of people ask this question. It's made up money. Yeah, I got news for you. The $100 that you have in your pocket is just a piece of paper, right? There's no intrinsic value there. And it's not even backed anymore by, it used to be essentially like a receipt for depositing gold. Okay. So that's kind of how it initially started, because gold, wasn't that divisible, right? It was not, able to carry large amounts of it. It wasn't really practical, right? So the dollar really used to represent how much gold that you had stored. But now it's fiat money. That fiat money basically means that it has absolutely no value, but it's backed by the full faith and credit of the government. And it's not backed by gold or any kind of precious metals like it used to be. So, basically the way a currency works is if people believe in it, right? That's the only way that it works. So,
that might be why you have the crypto, space that says cash is trash. They kind of use that term out there for exactly what you just described, because it's a fiat.
Exactly. So any monetaries, they used to use furs as currency. They used to use seashells, right? Any, unit of measure that people believe you can give to somebody in exchange for value, and it's accepted, can be a currency, right? So I would say that Bitcoin, though, it's much better than other currencies as far as from a value perspective, in my opinion, because you also have the network, you also have the technology behind it, and you have the removal of some of these critiques that you could have with other financial systems. Now, Bitcoin specifically, it's also finite, right? So why is gold valuable, right? I mean, yeah, it looks nice, right? But it's because it's a scarce natural resource, right? Meaning, right? So there's not an infinite amount of gold, and it's expensive to mine it from the earth. So it's scarce. Well, Bitcoin is probably the most scarce, like, solid asset that we've seen, meaning there's a fixed number. There's only 21 million Bitcoin that can ever be mined. Now, it's also extremely divisible. You can divide this thing into Satoshis, meaning like when you invest in a stock, you have to buy one stock. When you invest in a Bitcoin, you could buy like a millionth of a Bitcoin if you wanted to, right? So it's extremely divisible, extremely transportable. It checks all the boxes and is better than any of the other currencies as far as the character traits of money. But it's also something that you have to think about from an investment standpoint, right? The most common principle is supply and demand dictates price. Well, if you have an asset that, boy, over 93% or 92% or so of Bitcoins that can ever be created have been created already, and there's only 21 million that can ever be created, you have an asset that has a hard end limit there as far as the supply, very different from the dollar, which we know we can print our way, into problems, right? So that aspect of it is very different. The other thing is that all the transactions with, a lot of the cryptocurrencies like Bitcoin are final, meaning there's no manipulating the record. There's no, wiping out debts and things of that nature. So you might be asking yourself, okay, I kind of understand this principally a little bit, but you're telling me that this is a new monetary system and it works, but there's no banks that are keeping track of this. How does that happen? And this is where the blockchain comes in. And the blockchain could be a little mystic, right? But I like to try to simplify things. And it's really just a way, in the Bitcoin's case here, of verifying transactions without the need for the central bank or institutions. So just like Wells Fargo has my ledger for me, I want you to think about it in the same way, but instead of it being behind a security wall, it's a ledger that is transparent. It's broadcasted through the Bitcoin network, and everybody that wants to see it could see it. Now, there's something, and again, we're not going to get too in the woods here, but there's private keys, public keys. Basically, you can remain anonymous on there, but everybody can see the transactions that are occurring. So you don't know who necessarily is making it, but you can see what's occurring.
And this kind of sparks the idea or the debate of the illicit activity that could be taking place.
A lot of illicit activity happens with cash too,
Even though studies show there's less illicit activity in the blockchain space than there is in the central banking system. Studies specifically show that and have been presented to the Securities and Exchange Commission as well as to the federal government.
Yes. So there's millions of computers that are plugged into the network. And essentially, what the computer is doing when it does this is it's really verifying the transactions. Now, there's a question you might ask, which is, well, that sounds great. You got millions of computers that are keeping this record straight, and they're kind of acting as the bank would with this ledger, but here with this broadcasted transparent ledger that you can call it. But why would they want to do that, right? Why would these people want to use their computing power, right? Consumes energy. Nobody wants to do this for free. And the answer is that the reward is in the right place. So if you are the first to record the block to the blockchain, a block is essentially like a group of a bunch of transactions that they put into a block, and then you record this to the blockchain. So if you're the first one to do so, you get a reward in actual Bitcoin. And you also get any fees that are tied to the transaction. So there is a monetary reward for doing this work on this ledger that is distributed and transparent that everybody can see. Now, you've probably heard people talk about hash functions and solving a math problem, and you can get crazy with the explanation of it, but it's not really important for our conversation of just trying to understand this concept.
And the thing that's really, Dan, is this concept called mining? Is that what we're talking about right now is mining?
It is. So miners, when you hear mining, that means like, it's kind of like referring to like mining gold, right? Getting new supply of gold. And it's like miners are getting new supply of Bitcoin. And the point that I wanted to make is that the best thing I like about Bitcoin is that there's nobody out there that's dictating, here's how much money we need to create. There's no central bank. Instead, the supply is a byproduct of keeping the network secure. So the reward that I was speaking to, miners are essentially ledger keepers. That's what a miner is, right? A miner is somebody that has a computer on the Bitcoin network, essentially, or a cluster of computers that is essentially verifying the transactions. But because the byproduct is actually the only way that new supply of Bitcoin comes to the market, that reward that is given to the miner that records the block, it's called mining, right? So this is probably my favorite aspect of it, because the supply is pretty set. You know exactly how this is going to occur. So there is a mathematical equation, right? And there's a hash function that has to be solved. And because they wanted the supply of Bitcoin to be predictable, it's already on a set protocol, can't be changed. But this math problem essentially adjusts. The difficulty of the problem gets either harder or it gets easier depending on the progress that's being made on the network. Meaning they want it so that about every 10 minutes, a new block is mined to the blockchain. So if there's not enough happening, the difficulty can ease to kind of get it on average to that. Or if there's too much activity, they can make it harder to slow it down. So the bottom line is this. If you do the math, if there's a block every 10 minutes, that means in one day, there's 144 blocks that get mined on average. And the reward that miners get for writing the block to the blockchain is currently 6.25 Bitcoin. So 6.25 Bitcoin, 144 blocks. That means that right now in the current environment, 900 Bitcoin are created every single day on average.
Wow.
Pretty predictable. But one of the things we're going to talk about is something called the halving cycle, because it didn't always used to be that way. And this is one of the big things that's different than our monetary system. Bitcoin, it's actually an asset where you see inflation getting lower each year, as opposed to 40-year high inflation that we're all experiencing today. And you have the Fed stepping in and these mad scientists that are tinkering with important things in our economy. So initially, the reward when Bitcoin first came to be was 50 Bitcoins. So instead of the current reward, which is 6.25 Bitcoin, it was 50. So there was a lot more Bitcoin created each day. But then every 4 years, there's something called a halving cycle. What that means is that every 4 years, that reward basically gets cut in half. So after 50, it went to 25, it went to 12 and a half, and now we're at 6.25 as a reward. So something important to note, because every time before we've seen that occur and after, you see a big run up in the price of Bitcoin. Why? Well, because half the supply that's going to be coming to market is getting cut. Economics 101, supply and demand here, something that could be potentially exploited. But this is going to keep having, and you're going to see inflation with Bitcoin continuing to decrease, which again is very different than I think our current financial system here. So one of the things that I really like about it, but there's other things that Bitcoin and cryptocurrencies can be used for. And I think that we don't even know what those things are yet, right? So here's an example that I saw out there that I liked, where it was like, when steel was invented, right, it gave us like a new material that we could build skyscrapers with and bridges with, right? But when this thing was invented, nobody ever dreamed that you'd be building a space shuttle with it, right? But it's certainly a really important building block in a lot of the things that we do. One of the things I like is it says the oldest problem man has is, how do I protect my property from being stolen? We make a tribe, a village, a kingdom, a country. If no one can control the ledger, no one can steal my asset. If I want to send it to you, no one can stop it, block it, or prevent it. And this is a lot of the benefits of cryptocurrencies. And with Bitcoin, I truly do believe that we have a new set of building blocks, and we don't even know what all the future use cases are going to be. But I think it's one of the best risk-adjusted investments. And I actually believe that right now, specifically, is a very good opportunity. And I think that 2 years from now, people are going to look back at this time and say, man, I wish that I would have bought Bitcoin or other cryptocurrencies when they were so discounted. And we'll go through a few reasons why. But, a lot of people do knock Bitcoin for being volatile. And I know there's something you and I talked about, Quentin, where it's like, why is it so? Well, it's very volatile because the market cap is relatively small, right? So Apple's market cap is 2.5. Apple itself, the market cap is 2.5 times bigger than the total crypto space. So it's still, adoption is still in the early stages here. While that means there's more volatility, it certainly means that there's also probably a great opportunity before you get to the critical mass adoption, right? And clearly, we're in a bear market. Cryptocurrencies, roughly down about 70% from the highs that they set in November. So, if you've been invested in the space, it's probably been a little bit difficult, right? And we've seen this historically, where it's not uncommon to see in bear markets crypto lose 80% of its value. I don't think that's going to last forever. I do believe that as we get more adoption, as you get more institutional players involved, that the volatility is going to go away, but the returns are also not going to be as significant either. Now, a lot of people worry about regulation. I actually welcome the regulation because they've made it clear that the Fed SEC, they are not going to ban Bitcoin or cryptocurrencies in the US. The big question out there is this one a security? Is it a commodity? And it appears that they are classifying Bitcoin as a commodity. They haven't come out and officially said this, but based on reading between the lines of some of their comments, that's the way it looks like it's going. But the sooner we can get regulation and regulatory clarity, the better. And the reason why I say this is because you see so many companies out there, anecdotally, from talking with them, hearing from them, they have cash that they want to put to work, but they literally can't invest in cryptocurrencies because there is not that regulatory clarity. But once we do have that, just think about the flood of money that can be coming into the system and the adoption that can take place there. So I actually think regulation in 2023, which I think it's possible we get some more clarity, can be a very good thing.
Yeah, I think, aren't we supposed to get clarity on that here in November of moving in?
Yeah, it's hard to say because they always kick the can down a little bit. I feel like we've been saying they're going to give us regulatory clarity for a while, and then it gets delayed here. But I'm hopeful. Yeah. I also think that once we get a spot ETF, that could be something big as well. Right now, cryptocurrency is a little tough to buy for somebody that doesn't know how to do it, right? Like you can't just.
And I could see now, based on everything you're saying, why this looks like the gold standard. Yeah, I hear BIT referred to as that all the time, the gold standard of, or it's considered to be the gold of the crypto market because, it's essentially has the limited commodity, as you mentioned, but also, it's literally exchanging a limited supply, just like gold versus, cash, where it has essentially an unlimited supply.
100%. Now, we've talked about how the smartest minds in the world are innovating in the space. Hard to ignore a space like that, but also it's the best performing asset of the last decade, and it's not even close. And I think it's still early, and there's a lot of opportunity. Now, like I said, it's down about 70% from its all-time high if we're talking about Bitcoin specifically. But like I mentioned, I don't believe that the bottom is necessarily in all these markets. I am a firm believer that we're headed for a recession. Typically, in a recession, we're looking at the equity markets. In a recession with a bear market, the average decline from peak to trough is about 39%, for only 20-something percent when we're looking at, let's say, the S&P or the Dow or the NASDAQ, right? I think there's still some more room there. And because of the correlation, right now there's a pretty high correlation of cryptocurrencies to risk on assets, meaning because of the players involved, a lot of times they're selling the bath with the bath water. And I think that, if you see stocks move lower, it is a good chance that's going to pressure cryptocurrencies lower. But I don't think that's going to be that way all the time. Cryptocurrencies, one of the reasons everybody was so excited about it is because they thought it was going to be this uncorrelated asset where it could give you like additional alpha in your portfolio, not just like a high beta stock, which is kind of what it's been trading like. I think we're going to see that shift over some time, but I think a lot of it has to do with the supply of it too, and who's holding that supply. And, we're starting to see the numbers growing at a pretty crazy rate of people that really have high conviction. And this is some of the insights that on-chain metrics can give you access to. Remember, because everything operates on a blockchain, which is, transparent, everybody can see into this, you can analyze that data, right? If you can measure it, you can analyze it. Well, you can take a look at investor behavior and sentiment and, how many coins haven't moved in the last 6 months. If you actually look, there's like 78% of the supply has not moved in Bitcoin in the last 6 months. I'm sorry, for longer than 6 months. So basically what that means is that you have 78% of the supply is being held by people that have held through this crazy volatility that we've seen in the market and still haven't sold. What does that tell you? That, boy, you're locking up a lot of supply there. There's still enough where price can fluctuate that's still out there and available. But if you have that locked up, it's like throwing gasoline down. And when we get the next bull market, boy, if you have all this supply locked up, you have the new supply of Bitcoin that's going to be cut in half in 2024 when the next halving is. Boy, it lays the groundwork, in my opinion, for a really big escalation. You throw in some good regulatory clarity that we get, and firms can invest some of their capital into it. And I think it could be a very exciting situation. Now, I don't ever like to try to advise for people. And by the way, this is something I was talking to you about, Quentin. I wanted to show you. A lot of people knock Bitcoin for being volatile, which it is and can be. But take a look at this. You've probably heard of the VIX. The VIX measures stock market volatility. Well, just to give some of you folks an idea of how crazy the bond market's been and the mortgage market, this is the MOVE index. So this measures bond market volatility, just like the VIX measures stock market volatility. And you can see how it's really gone up, 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 up. It's highest it's been since, back in 2020 when we saw some of that craziness going on. But if you were to take a correlation of the bond market versus Bitcoin, and you looked at Bitcoin volatility versus bond market volatility, can you believe that the bond market's like it's actually gone up from here. It's like 8 or 9 times more volatile than Bitcoin in the recent months.
I would have never guessed that.
Yeah, pretty wild stuff, right? But this is something that we kind of went over, but it shows you what the schedule looks like as far as the supply of Bitcoin and how it gets halved, every 4 years until there's really, no Bitcoin left, in which case you have absolutely no more supply coming. But this is some analysis that I did taking a look at the previous halving cycles. And you could see where we talked about initially the reward was 50 Bitcoin. Now, the halving that occurred was like November of 2012, where that reward that miners received for doing that work and verifying transactions and writing the block to the blockchain, once the halving occurred, it got cut to 25. So the new supply of Bitcoin coming to market every day, essentially getting cut in half, hence the word halving. Well, what happened in the market before that in anticipation and after that, after the halving occurred? Well, 400 days prior from the trough to the halving, it was a 637% return. 371 days post the halving, almost a 9,000% return. How about the next halving in 2016, where you saw the reward go from 25 Bitcoin to 12.5 Bitcoin? Well, the trough was 518 days pre-halving, and from that point to the halving, there was 415% return. After the halving, 546 days post, it was a 4,000% return. The next halving, which happened in 2020, it's the most current halving that we're in, where the reward went from 12.5 to 6.25. 511 days prior to the halving, you saw a 345% return, and 539 days post-halving, there was a 624% return. Now, the next halving will be in 2024, and that reward is going to get cut in half again. Looks like, to me, it's reasonable to believe that you're going to see anticipation of this supply getting cut in half and potentially a nice rally, as well as after the fact, seeing a nice rally because that supply has been cut in half. One thing that's clear is the returns are certainly beginning to get slightly diminished, still extremely exciting. But of course, back here in the earlier days, you were seeing 9,000% returns. I think those days are gone, but you can certainly see a few 100% return potentially, right? And I think it's still an extremely exciting investment proposition. And I like looking at things that make sense, right? So this is just simple, right? Supply and demand. I'm not talking rocket science here.
Right.
But if you believe in some of these principles like I do, it might be something that's an exciting opportunity for you, and in a way that can help you maybe to have a multi-generational, in my opinion, investment opportunity. And one of the best times to invest is when people tell you that you shouldn't, right? Meaning, there's a lot of famous investors out there. You want to be a contrarian investor. You want to buy when there's blood in the streets, right? When everybody's ultra optimistic, that's when you should be selling, and vice versa. So, everybody's, knocking on the crypto market. It's down 70%. The market looks scary out there. It's difficult to time the bottom of the market. Do I think the bottom's in? Personally, no. Do I think it could go down lower? Do I think it could go down maybe to 14K on Bitcoin? Sure. But am I going to try to wait to time that thing perfect? No, because you might miss the opportunity. Instead, good strategy would be dollar cost average in, right? Yeah. So instead of taking your investable amount of money and just dumping it in one shot, spread it out, just consistently buy. So if price continues to go lower, you are continually dropping your cost basis because it's going to be impossible to time the market. Nobody is consistently successful in doing that. So that's what my advice would be. The investable advice here would be, whatever you're comfortable with, I would look at it as another segment of your portfolio, right? Any good financial advisor, which by the way, I used to be a financial advisor for Morgan Stanley, would tell you that you want to diversify, right? You don't want to put all your eggs in one basket. You want to have a percentage of your money maybe in stocks and bonds, emerging markets, right? Precious metals, Bitcoin. Even if you don't like it, I think you should have some exposure because of the potential opportunity that exists. And some of the stuff is pretty simple to understand as to why it looks exciting. You have the adoption, you have potentially the regulatory clarity that's coming. You have the smartest people in the world investing in the space. You have the supply and demand dynamics that are pretty unique to Bitcoin, and it's an extremely scarce asset. You have the kind of the utility function of it too, right? Where, you can have a monetary system without the need for central institutions. And, looking at some of the charts and such, I certainly think that I could see this next year to 2024. You could see this thing, in my opinion, well over 100,000. So you don't want to time the bottom, because you might miss the opportunity. And are you going to be that upset if you bought Bitcoin at 20 grand or 16 grand and now it's at 130 grand?
No.
Not really, right?
No, not at all.
So that's my opinion on it there, brother.
Well, man, I tell you what, I appreciate. I'm blown away by what you just shared with us for many different reasons. Number one, for our listeners, do yourself a favor. Do not go online. Do not YouTube Bitcoin. Do not go look this stuff up, because the people giving this advice here, they're not doing what Dan does, and they're not doing this for a living. Half the time, they're not even putting in the orders they tell you they're putting in, which then brings me to my next question. What platform do you recommend? I know probably the most popular one's Coinbase, but what do you recommend and why? Because it's not like they can go to TD right now, or to Morgan Stanley for that matter, or Charles Schwab, et cetera. They can't go. So where would an audience member go, in your professional opinion, to get started?
So I would go to Coinbase. There's a lot of other exchanges out there. And listen, I use KuCoin for leverage trading, which is something that's a little bit more on the advanced side and can be extremely speculative, but it also could be a way to hedge your position, right? If you don't want to sell your Bitcoin, maybe it's for tax purposes, maybe it's just, you want to keep adding to your position, but you want to maybe profit on the way down. You can go short with a leverage trade that can cover you to the downside for a lot of your losses. So anyway, not a US based platform, a little bit more risky there. It's, overseas. I use it for leverage trading because we don't have a corresponding option in the US.
Right.
But for the majority of your if you're buying Bitcoin, right, you don't want to do it through like Robinhood, even though they may have just recently changed this, or, PayPal, or these different options out there, because you're not getting the benefit of owning the coin.
There you go.
Now, what I mean by that is you're not taking custody of it, right? If you buy it through Coinbase, then you can actually take your coins offline. I can put them on my wallet, right? I can send them anywhere I want. There's something that we didn't get into today, but maybe another topic, but you can stake the coins, basically provide liquidity with those coins and earn a yield on them. All of these things are not possible if you're buying them through a platform that doesn't really give you custody of the coins. I would always, especially if you're new, I would go with something that's US based, something that is a public company. Coinbase would be the best one. The only issue is that it doesn't have all the coins, right? So you may have to use another platform if there's a specific coin that you're looking for, but it has the majority of the main ones.
Yeah, they're adopting them quickly by the days here. And I think it's really important of what you just said there, because there's a lot of places where you can't take ownership. And what Dan means by that is take the coin off the exchange, put it into a digital wallet, which you will see and have access to. And Coinbase recently opened it up where you can use your own wallet at Coinbase or their wallet. And it's a very ease of use mobile platform. Very, very, the one thing I learned about crypto that didn't happen in my stock accounts, never happened in any real estate transaction, the amount of verification that you have to do to even open up one of these accounts, you don't have to worry about something being stolen, because someone's going to have to actually steal your face to do it, because they require you to upload your ID, Face ID, et cetera. It's very secure. So the idea of it not being secure should be something that no listener should worry about, because it's extremely secure.
But listen, the Coinbase is very secure. It's not that cryptocurrencies aren't secure, but just like, you can have a bank that gets hacked, right? You can have a exchange that potentially gets hacked, or a company that can get hacked, right? So, it's not that there's deficiencies within the blockchain per se. It's, a company's security potentially, right? So, these are things that can potentially happen out there, but you certainly can't have that happen if you take custody of your coins yourself and take them offline. But Coinbase is the go-to one that I would recommend for ease of use, for safety, for starting out. But you do want to be careful with like wallets and stuff.
Mm-hmm.
This is not something that I would recommend doing without taking your time, because the transactions on the blockchain are irreversible. So if you accidentally send coins from an exchange to a wrong address, they're gone, and they're gone forever, right? So it's a good and bad thing, but you just have to be careful. That's all.
Right. And then that's great advice. And then the other thing is, what do you say to the people that are listening to this and go, you know what, I did the crypto thing. I saw the run up and I saw the decline. And both times I tried to get online and my account said, server maintenance issues and couldn't get online. And some of the exchanges were not allowing people to get in there. Would you say that's a thing of the past, or that was ironic, or just an extreme amount of traffic on there that caused those kind of collapses?
Yeah, I mean, listen, there's certainly always growing pains with exchanges. And, I think that I don't know for sure if that's ever going to happen again. Right. But, I would like to think that they've made some improvements there when you get heavy points of traffic like that. But if you saw the rise and then the fall, I would say it's probably a learning experience where a lot of times people ask me, I'm in profit. When should I take profit? Well, if you're asking me, it's probably not a bad time to take some chips off the table, right? but like you can't get too greedy. You got to take it's no shame in walking away with the profit, right? So. But and I also want to be prudent in that, you don't necessarily, you don't want to put your life savings in something like this, that if you need access to the money for something in the near term, I wouldn't suggest that either. So.
Right. Well, and that's simple, sound financial advice. We wouldn't put that in the stock market. Wouldn't put it in your 401k. If you need it, you need it. And moving towards, I wish we had time to talk about this one. I wish we could talk about Ethereum. I wish we could talk about the benefits of it. I think that's probably the second big dog on the crypto market.
Oh, yeah, for sure.
Ethereum 1 and well, I guess 2.0 is just Ethereum. I would love to venture into the staking and talking about that. I don't know how much time you have. If that's another episode.
Yeah, I got something backed up against this.
Yeah, I saw you get antsy there. But I would love to redo this and have that conversation, because I think our audience, as they kind of dive into this and realize what's going on, that this is a space. And so, guys, I know Dan's got to go. His time is very precious, man. I cannot thank you enough for being on the show. If you will, guys, tune in, check out the bottom here for Address to Crypto Charge. Check this out. I mean, it's sound advice and it's unbelievable. And also check out, you want to promote your YouTube channel here as we're starting to get people to sign up for that?
Yeah. So started a new YouTube channel, a show called the Dan Habib Show, really kind of breaking down, what's happening in the economy, economic reports, kind of short hit videos to just give you some insights every week, a couple videos a week. And then if you are interested in learning more about the crypto space, we've really tried to create a platform that I think is unique in that we come from a multifaceted approach in giving you sound advice and giving you an edge in investing. Every day you get a video breaking down the market, technical analysis, on-chain analysis. I think that you'll really enjoy it. You can sign up for a 2-week trial. If you want to sign up with us today, if you use code Habib, you'll get 40% off. So it's very affordable and reasonable. And I think certainly can help if it's a space you're interested in getting involved in.
Dan, thank you so much. Thanks for doing that for our listeners. Guys, for more information, go to his YouTube channel, Dan Habib. And then also, guys, for local Jacksonville advice, please check out the podcast at What's Your One More. Guys, again, thank you for your time. Dan, cannot thank you enough. Thanks for being on the show, brother.
Thanks so much, man.
Take care. Thank you.
Take care.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.